hello everyone. I'm delighted to be joining you this morning, or my morning, for the really important topic of whether there has been a significant shift in bond demand following the COVID-19 pandemic that has been affecting the world and which has led to huge demands for financing, whether that's from governments or from multilateral institutions who are working so hard to help both from an economic and a health perspective. That huge COVID-19 funding need has meant that the traditional sources of social bonds and climate bonds has seen a real change this year. So I think many of you will know that green bonds have been a feature of the capital markets since 2007, when we saw an inaugural climate awareness bond issued by EIB. And since that bond in 2007, in September this year, we reached the landmark of $1 trillion worth of green bonds coming to the market. And the growth in those green bonds was seen as inevitable and growing, mostly for the reasons that George has alluded to, that there is a climate emergency, the need to decarbonize the world is more important than ever. And of course, we saw that with the announcement of the new climate award. But this year, because of COVID-19 and because of the need for social funding, we've also seen a very large increase in social bond issues. And I think if we had been doing this event a month ago, we would have been talking about whether social bonds have eclipsed green bond issues. What we saw in September this year, particularly, was actually that green bonds came back. And so September 2020 showed a record month for volumes across the total of green, social, sustainability and sustainability linked bond formats, with more than $50 billion in September of green bond issuances alone. So we have seen in the third quarter to 2020 a doubling of that combination of those four different kinds of bonds, which in shorthand we'll refer to as social and green bonds. And so that huge demand, whether that's for social bonds or whether that's for green bonds, does seem to have indicated that there is now a fundamental shift in the capital markets, and that it's not just a niche area that certain ethically minded investors are looking at, but that it is something that will affect the capital markets in general. To discuss that topic, we have two amazing people to help us explore the issue further, and let me introduce them to you. First of all, I'd like to welcome Eila, who is a director and head of capital markets at the European Investment Bank. Eila chaired the executive committee of the Green Bond Principles from 2015 to 2018. She's represented the EIB at the EU High-Level Expert Group on Sustainable Finance in 2017 to 18, established by the European Commission. Currently, Eila is an alternative member of the Board of Directors of the EIF, the European Investment Fund. She also represents the EIB at the Technical Expert Group on Sustainable Finance, created by the European Commission in 2018. In July 2020, she was elected as member of the board of International Capital Market Association, ICMA. So thank you, Eila, for joining us today, and I'm very much looking forward to hearing your thoughts on this important topic. I'd also like to welcome David Jenkins. David leads National Australia Bank's Sustainable Finance team and has been active in sustainable debt financing for over 10 years. David is an active member of industry bodies, including the Australian Sustainable Finance Initiative, New Zealand Sustainable Finance Forum, the ICMA Green Bond and Social Bond Principles Advisory Council, and Climate Transition Finance Working Group, as well as many others. And he's actively involved in several industry sustainability initiatives. National Australia Bank has also received numerous sustainable finance industry awards. So with that fantastic panel. Let me start by asking really for your initial thoughts on whether you think COVID-19 has triggered a shift in bond demand, or whether this was actually just the way things were developing in any event. Eila, could I go to you first for your thoughts?
Thank you, and thank you for the invitation to this discussion as well. Well, I think there are several things to take into account. First of all, we have seen a surge in social bond issuance and COVID-19 response bonds and all of that. Of course, that's related to this particular crisis. And yes, in a way, if you talk about ESG, then we have all been saying since 6 months that the S is finally catching up with the E letter. We have been very focused on environment, but of course, environment and social go very much hand in hand. If you have environmental problems, you also have social problems, and vice versa. I mean, this is very clearly related. But and usually we think about this as, for example, sanitation problems in poor countries. But now we have seen that these are also very much related affairs in the developed economies. So social bonds have surged this year, yes, because we got a terrible economic shock, which is impacting the economies, the job situation in practically every country of the world, basically. So that is natural. The social spending and social expenditures, mostly by the public sector, obviously, because they are the ones who need to respond to this, have been the main actors, because they are the main finance providers to all of these needs. So in that sense, I think it's normal. But I would say that, well, we shall see if the volume of this market remains the same. I guess it also depends on the needs that we are going to see. If the economy recovers rapidly, which I'm not sure anybody is very convinced about right now, then of course the needs may be smaller. But something that will remain out of this, I am sure, is the aspect that people are focusing more on these questions. We have learned now, investors and everybody, all stakeholders have learned over the years to ask questions about the environmental affairs of the borrower, or who wants your money in the form of bonds, in the form of equity, in whichever form. These questions have been asked, and not only by the investors who have labeled themselves green, but by every investor. Everybody has learned to ask these questions because they have learned that this may have a consequence for the financial performance. And now I think we are coming to the same conclusion on the social side. So even if you have a corporate who doesn't really have a social function per se, but investors are starting to ask them questions. So what are you doing with this money? Are you investing, or are you buying back shares? Are you paying it out in dividends? What's your policy? Have you been furloughing people during this crisis, or have you tried to keep your workforce there? Have you been treating badly your employers? What are you doing? What is your sort of societal responsibility? So yes, social bond issuance and COVID-19 response bond issuance has mostly come from a certain sector, but these are not the only people who will get the questions, and they are not the only people who need to care. And I think we will talk about the relationship between the social and green bonds a little bit later on, so I will not preempt that discussion yet. But to me, the social aspect is here to stay, irrespective of the volume of the social bond issuance. And here I have to say that I do wish that people did make a difference between those people who are actually telling what they will do with this money that they borrow, and those who just say that, well, this is COVID-19 response and I've got some extra expenses. Do ask those questions. They need to be answered, whether they are coming in the form of reporting on the bond and telling you what is the use of proceeds use of the bond, or if people tell you otherwise what their policies is. But these questions need to be asked, and they need to be answered by everybody, public sector and private sector. They may have a different angle, but the social angle in finance is here to stay. That is absolutely certain, whatever the bond market volumes will be.
Thank you, Eila. There's a lot, I think, for us to unpack during the discussion. But David, can I ask for your, I guess, overall impression of whether we're seeing a permanent focus by investors on sort of sort of social ESG type investment, or do you think this is just a short-term response to the pandemic?
To Eila's point, I mean, the S and the ES and G acronym has certainly been the small sister, or if you like, the little brother of the green bond since the outset of that market. But it is fair to say that over the last 12 months, we've seen a convergence of issuers increasingly establishing broader ESG bond frameworks to encompass both green, social, and the combination of both uses for those sustainability themes, but also explicitly aligning and identifying contribution towards achieving the SDGs. So that momentum has been happening in the background before the COVID pandemic hit us. But what we've seen since then is certainly with rapid pace, the quick pivot from the issuers led by the likes of the EIB and the super sovereign agencies, pivoting to raise finance to deploy towards social infrastructure and social uses to address the pandemic through the COVID period. Initially, to the detriment of the green issuance volume, we saw corporates essentially stopping because they were very much focused on liquidity and essentially raising debt to keep themselves liquid and functioning and addressing their near-term problems. We've, since that point, moving through August, September, seen that gradual reversion to the mean of green bonds rapidly returning to far and away dwarf the social bond issuance. But we have seen a number of corporates that have come into the social bond arena that haven't been there in the past. Numerous issuers have dusted off their social bond programs and taken the opportunity, as they've incurred and deployed more finance towards socially positive uses, to issue in that format. We've seen a number of financial institutions finally, they've not been the leaders, but Bank of America, a number of Asian banks have issued in that format. To a lesser extent, corporates, I mean, we've seen the likes of Novartis and the others issuing in sustainability or sustainability-linked format. But I think it's most definitely here to stay, as most of the established frequent issuers in the bank space who have set up green bond programs have either expanded that over time to incorporate social bond platforms, or they've established broader sustainability theme to allow them to issue in either of the three formats. So on a go-forward basis, I definitely think the social issuance market will be here to stay, and investors have been in the same way very much supportive of these issuance. And I'm sure Eila can talk to this at length, but there are certain pockets of investors who have a specific focus in terms of social needs, where they will say, we would like to invest in a social bond that is deploying funds towards pandemic vaccine development or healthcare expenditure or personal protective equipment, things of that nature. So that's here to stay.
Thank you, David. I wanted to explore that a little bit further. That whole chicken and egg question of, have these social bonds come to the market now because there is a funding need, and so governments and others are going to the market and saying, we need to raise money, and by the way, this is our use of proceeds. Eila, this was the comment you were making earlier about the basis on which this is being issued. Or is it actually being driven by investors who are saying, we do want to invest in things that make a difference, that will make life better? Or is it actually just a combination of the two that is being given an acceleration because of the pandemic environment we're living in at the moment? What's your sense, Eila? Is it investors, or is it issuers, or is it actually both?
Yeah, it will be interesting to hear David's view, because he's working for an underwriter. But I think there's a bit of both, push and pull, when especially the public sector saw at the beginning of the year that they will need to raise huge amounts of money, and a lot of this will go into social purposes, be it then because people go unemployed, or healthcare systems need to be stepped up in a very quick pace, and all of that. But also investors started to ask, can we do something? Can we buy something? And also I have to say that the definition of social bonds until this spring was a little bit narrower in the sense that you had to have defined, for example, a target population, which was somehow people who were under a certain income limit, or people who were unemployed, or any kind of sort of target population. So it wasn't a general population, could not be the target. And that was changed this spring because this COVID-19 impacted anybody and everybody irrespective of your social or financial status. And that also changed things, so that made it easier. You did not need to define anybody who can be my patient. I can choose that one, but not this one. So that made it a little bit easier. But investors' side, social has been a bit more difficult for them than environment over the years, because environmental, the game is pretty much the same globally. If you avoid, for example, carbon emissions in the United States or in Europe or in Asia or in Australia, it's same thing. Or if you have a clean drinking water in any part of the world, it's the same thing. Whereas social has been much more difficult to define. What is considered a social finance in Europe may not be considered such in Africa. But here, this COVID-19 pandemic made this again a global point, that we've all got the same problem. And rich countries, poor countries, everybody had problems with their healthcare systems, not at the same level, of course, but this was everybody's concern. So I think this made the problem global, which we haven't really had in social bonds world, unlike in the green bonds. And I think that was also part of the response, both from the issuers but also from the investors. So now, if I got a COVID-19 response bond as a use of proceeds of the bonds that I'm buying, then I don't need to sort of care whether it's Holland or Vietnam or Brazil. It's good everywhere.
Thank you. Thank you. I think we have a bit of a mismatch between the sound and the video for Eila. So
yes,
David, let me go to you. I guess, I mean, I'd welcome your thoughts on that. Is it investors driving this, or is it issuers, or is it a happy combination of the two from a bank perspective?
I think it is a combination of the two. To Eila's point, until I guess the COVID pandemic took effect, and the leadership of the EIB and the IFC with the first issues in this COVID-19 social bond format, and then the work that the Green Bond Principles ExCom led to put together some guidance around what is a credible COVID-19 themed social bond. And as part of that work, they addressed probably the key stumbling point around how do you define the target populations, which Eila touched on earlier, which through the pandemic is extremely broad. It's essentially the global population, but also the key use of proceeds and the key impact metrics. That has been the big challenge. On the issuer side, issuers are, as they should be, increasingly concerned of going down this path and being labelled of greenwashing or social washing. That guidance, the ability to be able to identify clearly tangible and understood social uses of these proceeds and clearly defined social impact metrics, has definitely helped from the issuer side, but also from the investor side. So if you consider the green bond world, when they first came to fruition, it was really all around climate mitigation and avoided greenhouse gas emissions, which is easily understood in terms of the metrics and the reporting elements. That's grown over time into a range of different metrics, but in the social arena, it was extremely subjective because of such a breadth of potential use of proceeds. So the pandemic has, in a way, crystallized and clarified what credible COVID-19 social bond use of proceeds and metric reporting are, which has helped both the issuers and investors to get comfortable. But I think what we've seen is more broadly the focus on sustainability, the focus on addressing some of the social imbalances through the pandemic has picked up at pace. So investors have been extremely willing to actively support issues of this nature, with the caveat that they are in fact being deployed in that way. And to Eila's point earlier, not just saying it's a bond and we'll use it for COVID-19 users. Trust us, we'll come back to do that. And as the pandemic's gone on and on, we've seen increasingly loud voices and increasing expectation that you will in fact report, and investors expect to see at the outset what metrics you're going to report on, and if you're not, then how are you going to? And in many cases we've seen is on the underwriter side, investors will just walk away. It's no longer an option to quickly scramble, put something together and issue it under the banner of a social bond and expect investors to buy it regardless. I think those days are well beyond us now.
The guidance of the ICMA guidance on what constitutes a social bond and a sustainability bond and a sustainability linked bond, all of those came out this summer. Eila, do you think that is, to David's point about the demand from investors for transparency and accountability, do you think that guidance is now sufficient? Because there has been criticism that some of the descriptions around what the proceeds were going to be used for and what the reporting was going to be was certainly a bit thin when this market first started. Do you think we're past that now? We now have a metric. I guess the other thing I wanted to ask was, do we need all of these different metrics when actually what we're looking at is impact, and the guidance is sort of similar, but it's not a single guidance? Does it cause confusion, do you think?
Well, I think not necessarily confusion, but of course the idea with green bonds and social bonds, and then sustainability bond, which is a mix of green and social. Some people use sort of both, and they mix both in their use of proceeds. And sustainability linked bond, which is a different instrument in the sense that all the previous ones, they are kind of a capex related bonds basically, whereas sustainability linked bonds can be used by anybody who hasn't got capex and is linking it to some key performance indicator in the company's, usually corporates, own performance. So I think the green bond principles, social bonds principles is a platform by market participants, it's underwriters and issuers and investors. And we have said from the beginning in that group that we are not regulators, we are not technical experts, we are not environmentalists. We cannot tell you what is, for example, a suitable technical screening criteria. What we do is recommending best practices, recommending transparency, and then there are certain rules about reporting, which is also fairly flexible. We say that you should do reporting, but how exactly you do it or which parameters or metrics you choose is also not at all sort of dictated. There are some formats for impact reporting for a variety of sectors now, but these are just models to be used or not used or adapted as you like. Now, if you combine that with the recent developments, especially in Europe, but also in other parts of the world, in terms of the development of taxonomies, which are granular and detailed, which tell which activities can be considered green and with which conditions. So, for example, I don't know, my train line can be considered green with these and these conditionalities and these technical screening criteria. Now it is the European Commission who is the regulator, legislator. They can do this, and they have employed first dozens and then hundreds, if you go and look at all the people they have consulted, technical experts who can actually put down this kind of detailed information and data. So if you combine the market which first developed best practices on a voluntary basis and has come very far. I have worked in finance for 35 years and I've never seen anything similar, having all these different participants coming together and working on best practices. This is totally unique. And the regulator, I think, very wisely waited until the market was out of its infancy, especially the green bond market, and then started to build on that basis and then put in place some kind of regulation. So now the combination, I think with this combination, we start to have a sort of a full set. Of course, the taxonomy is not complete yet. It's only 2 out of 6 environmental objectives is done. And this is for the EU, but the same kind of format and framework can be used by anybody. And of course, you then put your own screening criteria there. But if we can start to think in a similar kind of model, all of us, whatever your content is, then I think that will create a very powerful framework even globally in terms of with which you can work on. So I think we need sort of both parts. We need the voluntary work, and that is continuing on social work on sustainability linked bonds. This is going forward, and maybe one day we get similar legislative or regulatory initiatives on that side as well. But I do believe that we need to get the voluntary basis first and have that done, because if legislature steps in a bit too early, they probably don't get it quite right. Whereas now I think we are on a good track. So when so many people were afraid of what this taxonomy, for example, would be, my response to that was that for all these years since we started the institutional market of green bonds, 2013-14, it was the most frequently asked question was, yes, but what is really green? Who decides what is green? So now we are getting there as well.
Thank you. David, you talked about investors walking away if they weren't happy with the sort of reporting and transparency of how proceeds were going to be used. And yet some of the more established investors in this market have their own frameworks. They have their own taxonomies in place for what they find acceptable. Do you think that we're going to be able to develop a global framework at speed for social bonds broadly, so that we're not going to have all of those different approaches, but we'll have effectively a single approach? And will that help for the market to grow?
I mean, we're rapidly converging on a single framework. I mean, the format of the Green Bond Principles, with the 4 principles of the use of proceeds, selection of projects, management of proceeds, and reporting, is essentially being replicated globally across the various regions that are all adapting and refining those. Where the difference will be around the use of proceeds, how those are defined, how the target populations or those expenditures are identified, and the metrics that are reported. I mean, they're very much specific to the issuer, specific to the region, specific to the sectors being funded. If you think about, in the case of many of the SSAs with their some of the inaugural social bonds to empower women and gender equality focused bonds, I mean, they're very different to a number of the gender equality focused bonds and social bond format we've seen coming out of developed markets. In our market, it's been very different. It was for funding companies that were at the leading edge of gender equality in the workforce, as opposed to a number of the social bonds that have been focused on emerging markets, which are really about lifting, in many of those cases, lifting women out of poverty and empowering them to develop their own businesses, and with that come the social benefits. I think it's probably a bit too narrow to think we'll ever land on a single rigid format, and that's why the principles work so well, because it gives people the guidelines, and then with the support of a credible second party opinion, which then will drill down into the qualitative assessment of the framework of the issuer under those principles, will give more comfort to the investors that look to invest. And I think we are seeing increasing levels of sophistication in the investor universe, to your point, applying their own screening frameworks, their own investment criteria, but those that are early in their journey rely heavily on those second party opinions and the comfort that a credible second party opinion and being able to compare a social bond from this issuer to that issuer and how the use of proceeds differ.
Thank you. Eila, in terms of, I guess, where this market is going, we've seen the EU publish its plan to deliver a capital markets union by the fourth quarter of 2023, where it talks expressly about a key objective being supporting a green, digital, inclusive and resilient economic recovery. Do you think that kind of focus is going to help to really drive the growth of social bonds in the capital markets? Do you have a sense of how big this market could become and what could perhaps hinder its growth?
Well, yeah, thanks. If I take the capital markets union, that is a sort of bigger framework of trying to get, for example, corporates and SMEs getting funding from elsewhere than banking sector. So that's I think what they said, that this is just a general picture that we would like to have a more inclusive, digitalized market and all that. So this is not so directly, in my mind, at least linked to these objectives. It's just a general environment into which they want to put it. But I think what EU, for example, has done on sustainable finance side has been taking giant steps, and it's sort of bringing this whole thing to the forefront. So as I said at the beginning, I think the idea that you bring social aspects and environmental aspects into finance, that is with us to stay, and it doesn't need to be called social or environmental or sustainable. What matters is that it is in its content, that people who move around the money are looking into these things, and whatever it's called is kind of a secondary. What this labeling means is that when you put that label, you kind of raise your hands and say, I'm prepared to be transparent, I'm prepared to engage in a dialogue with all the stakeholders, but especially investors, and ask any complex questions they may have about how we do things. So that's what it means to be labeling. It doesn't mean that you put all of a sudden, you double your investment in this area, which you did not do before. And it doesn't mean that people who don't label don't do these things. What is important is what happens. But the green bonds and sustainable bonds and social bonds, they promote the transparency, because you say that here I am, ask me, I'll show you. If you don't think that this is enough, ask me more. And this is the important aspect, that we bring the transparency. And of course, when you are transparent, well, all of a sudden you are accountable. If you did not do what you promised to do, well, you're a bit in trouble. So this is the process. And I think ultimately, of course, some people have said that, well, in 20 years' time, let's not put it too far because we want to be ambitious. In 20 years' time, all finance should be sustainable, both in the environmental and the social aspect. And then we don't need to label anymore because it's taken for granted. But we are not quite there yet. So we still need to do this labeling, and we need more people to raise their hand and say, hello, I'm prepared to be transparent in terms of what I do socially or what I do environmentally in both. So this is to me the sort of the big picture, and how you do it then is kind of a secondary. But for the time being, we need to use the tools that we have.
Thank you. Eila, David, Eila talks about labeling being not as important as the substance of what's actually done. But the reality, of course, is that investors have certain areas of focus in terms of how they invest, and labeling helps them to allocate that. And what we seem to be seeing is that investors are allocating more of their investment pools towards ESG, social, environmental bonds. So we are actually seeing a growth in the amount of liquidity that's available to this area, which then encourages labeling by issuers. Are you seeing an impact on pricing as a result of that? So will investors accept a lower return on these socially worthwhile bonds, or do you just have to pay the same, but you get access to this funding?
It's very much a balancing act. What we are seeing is ex post examples of pricing outcomes when the bonds have been brought to market, of purely by the sheer volume of demand and the stickiness of investors through a book build process, being less price sensitive and less likely to leave for half a basis point. And probably the best example of that is what's happened in Europe over the last 2 months, roughly, where there have been several examples of issuers coming to market with standard unlabeled debt, and then green or sustainability themed or labeled debt, or social bond debt even, and seeing them price inside their standard issuance curve. You could argue that that was a function of the labeling, a function of the use of proceeds, a function of a combination of all these factors, the investors being motivated to invest in those. But increasingly, that is being repeated across multiple markets, not just in Europe. We've seen that to a lesser extent in the US dollar market. We've seen that in our market. But it is a balancing act, because certainly we as an underwriter can't hand on heart say to an issuer that you're bound to be getting a cheaper source of funding from the outset. If the credit, the underlying credit behind the issuer is not reflective of the pricing, then most definitely they should expect to pay more. I think in many cases, we have moved past that concern that green and social label bond are very niche. There should be an illiquidity premium, and investors were certainly advocating hard for that at the very outset of the market. We're well beyond that discussion now, to the point where investors it is essentially becoming mainstream. So green and social bonds appeal to both mainstream credit investors or rates investors, but also to those motivated ESG seeking or themed investors. The combination of all those factors are really delivering, and I choose my words carefully, competitive pricing outcomes. And they can take many forms. It can be smaller new issuance concessions. It can be larger books as price tightens. It could be price compression from initial price target to final pricing, and also the secondary pricing.
Access to longer maturities. Yeah. Better
Yep.
access to longer maturities sometimes.
Now, that kind of pricing benefit, even if it's not huge, does drive issuance in quite a significant way. I have found in the Islamic capital markets, which is what I focus on, just because you have access to the conventional markets, and then you have access to the specific market that's focusing on that product. So in light of that, Eila, and I'm conscious that we're coming to the end of our time now, in the last 6 months, we've seen a lot of social bond issuances by institutions like yours and by governments and others who've had to raise money quickly to deal with the pandemic. But I think David talked sort of very briefly about some of the corporate issuers that were coming to the market. Do you think the kind of pricing benefits that might exist together with investor interest in this and the clarity around standards will drive sort of many more corporates to see this as a market that they should be tapping?
Yes and no. I think, of course, corporates don't have that much social use of funds, which is normal. It's a public sector who normally takes care of this. But I think what can be done, I mean, we have now started to see, for example, corporates who have done these sustainability-linked bonds. We have seen, for example, a pharmaceutical company. We have seen consumer goods companies, and so on and so forth. And I think this could be their way. I mean, corporates already have had, even in green bonds, they have had a little bit of difficulties finding enough of capex to do this. Hence, the sustainability-linked bond, which can be linked to social objectives or environmental objectives, or both, a mix of both. I think that's a good tool for them. So social bonds per se, which are use of proceeds, which are capex type of bonds, I would not expect a whole host of those. But sustainability linked bonds, I think I would see. And I think we had to wait now for, well, we lost maybe this spring in many ways, but now we have started to see more of these coming to the market. And I think this is an instrument through which corporates can show their colors as well.
Thank you. David, the last question to you. Our hosts are based in Scotland, and I know there's a lot of excitement about COP26 being in Glasgow next year, having been deferred from this year. Do you see that as a real driver for a further increase in green bonds? We've seen after a slow start this year that there's been a big uptick in the number of green bonds coming to the market to September. Do you think that focus on the environment next year will mean that there will be a very substantial increase in the number of green bonds?
Given the period of relative subdued green bond issuance we've had through the COVID pandemic, I'd expect we'll certainly see that backlog push through and come to market and leading up to COP next year. And we've also recently seen the flurry of sovereigns that have been first-time green bond issuers. So that is only going to continue. The fact that they've issued once will no doubt lead to them being repeat and frequent issues of green. And as we move towards the COP announcements, exactly as we saw last time, a number of when Fiji were, I guess, the president of the initiative a number of years back, they issued their very small sovereign green bond, but it's fair to say that what's happening in Scotland next year, we'll definitely see something coming. I mean, we're all watching with bated breath to see what the UK government does, but there are many other Europeans and Northern Hemisphere countries that are well progressed. I wouldn't be holding your breath for the Australian government to issue a sovereign green bond ahead of that, personally, but that's a topic for another time. In the corporate sector, definitely there'll be opportunities, but it will be led by the public sector, I'd suggest.
Great. Thank you, Eila and David. I found that fascinating. I'm very grateful to you for your expertise, and I can see that there have been some very positive comments coming through on the chat function. So can I say thank you to both of you, and thank you to everybody who has been listening into this session. Thank you, everyone, and goodbye.